2022 is widely seen as having been a strong one for India's banking sector, both in terms of balance sheet growth and asset quality. Now, this optimism, of course, we've seen in the movement of banking stocks as well over the last 1 month, whether it's large caps like ICICI Bank or Kotak, or mid-sized lenders like a federal bank. So let's dive right in and find out how Q3 is likely to turn out for the banking sector and what factors to keep your eyes on.
Q3 is set to be characterized by growth gathering pace and uptake in collections with recovery in business activity. Leading financiers have reported 3 to 8% QOQ loan growth, and YOY growth too has gained traction. With lower slippages and improving recoveries, we expect improvement in the overall stress pool and credit cost for banks. Private banks are expected to outperform thanks to the retail festive cheer. Provisional Q3 credit growth numbers disclosed by some banks too were slightly better than expected.
Indeed, early release of key numbers for Q3 by select banks show that loan growth has seen a sharp improvement sequentially. Of course, there are some lenders who've lagged here. However, larger lenders like ICICI Bank, HDFC Bank and Axis are expected to report double-digit growth. In fact, ICICI Direct's analysts believe that private banks with healthy capitalization should grow at 10%, gaining market share from public sector lenders.
For the industry, loan growth has improved to 7.4% in December from below 6% in June. Core interest income growth has been found wanting in the past 2 quarters and could see some improvement in Q3 FY22. That is because incremental slippages are likely to be low for banks. With controlled fresh slippages and sustained momentum in recoveries and upgrades, the street expects definite improvement in the overall stress pool. If fewer loans turn bad, the loss of interest payment is also recouped to some extent, which would reduce the impact on net interest income for banks. A dip in slippages would also mean that potential provisioning need would be lower. This would have a direct impact on profitability. As such, lenders have built enough provisioning in the past 2 quarters for future stress. Analysts at Jefferies expect a slight moderation in slippages and credit costs as banks may see the tail end of downgrades and provisioning from COVID's second wave. They see slippages moderate to 2.3% of past year loans.
While the third quarter would bring in good tidings for banking sector earnings as well as stocks, investors cannot rest easy as yet. Why? Well, the restructured loan pile of most banks, if you remember, showed a sharp increase for the September quarter, and the performance of this pile will be key to watch. Moreover, loans extended under the government's credit guarantee scheme have shown incipient signs of stress. Then there's, of course, the resurgence of COVID cases and the new OMICRON threat.
The street believes private lenders are likely to post healthy profits driven by better growth, NIMs, and contained provisions given higher PCR and buffers in place. However, analysts say a fresh COVID wave could delay provision buffer utilization. Public sector banks are also expected to report better profitability aided by contained provisions but weak treasury performance amid rising G-Sec yields, and the absence of a one-off recovery like DHFL could keep earnings growth in check. Here are the key factors to watch. The asset quality outlook amid rising cases of Omicron. Commentary on slippage, performance of restructuring book, collection efficiency and provisioning amid the rising wave would be key monitorables. Commentary on the growth outlook, capex revival and the margin outlook would also be key to watch out for. The traction in fee income and treasury performance due to a rise in bond yields would be another monitorable. So which stocks are the brokerages betting on? MK believes ICICI and SBI with a higher share of secured mortgage book, proven track record of minimal dislocation during the last 2 waves and reasonable valuations provide a good entry point. Meanwhile, Centrum prefers large banks and Federal Bank. ICICI Direct sees growth momentum gaining traction for HDFC Bank and Kotak Mahindra along with Federal Bank. It also says that stress is being managed well by SBI and Axis Bank, thereby highlighting them as their preferred picks. Motilal Oswal meanwhile likes ICICI Bank, SBI and HDFC Bank within the banking universe.